A firm sets a pricing rule where only the base price is made fully visible at the point of comparison. The incentive is to minimize visible price while shifting part of the cost into less salient channels, creating a gap between displayed value and total burden. Customers respond to the visible signal because comparison across options is anchored on upfront price. This concentrates demand toward offers that appear cheaper, even when total cost is not minimized. The firm adapts by externalizing costs into add-ons, delays, or indirect charges that are not included in the primary price. This preserves competitiveness at the signal level while maintaining overall revenue through hidden extraction. At first glance, the lower visible price appears to reflect operational efficiency, but the observed advantage does not align with actual cost structure, indicating a divergence between signal and underlying burden. Competing firms face pressure to match the visible price signal to remain comparable. They replicate the same externalization strategy, increasing the proportion of hidden cost across the system. As more actors adopt this structure, the visible price becomes less informative about total cost. Customers continue optimizing based on the signal, reinforcing demand for distorted pricing. The system begins to reward pricing configurations that minimize visible cost rather than total cost. This shifts firm behavior toward optimizing presentation instead of reducing real economic burden. A customer selecting the lowest visible price encounters additional charges during usage or completion. The initial decision remains rational under the visible signal, but leads to higher realized cost after commitment. This creates a repeated pattern where early-stage comparisons are decoupled from final outcomes. The system accumulates decisions that appear efficient locally, but produce aggregate distortion. One might assume that repeated exposure to hidden costs would correct customer behavior over time. However, the cost is often fragmented or delayed, preventing full integration into the initial decision signal. Because the cost structure is opaque, customers cannot reliably reconstruct total cost at the comparison stage. This maintains the advantage of firms that prioritize signal optimization over transparency. The pricing environment now shifts toward layered structures where base price is only a partial representation. Each additional layer increases the gap between perceived and actual value. Firms that attempt to present full cost upfront appear more expensive in comparison. They lose visibility in selection, even if their total cost is lower, reinforcing the distorted incentive. This creates a lock-in effect where honest pricing becomes strategically disadvantageous. Firms are constrained to maintain hidden cost structures to remain competitive in the signal space. The distortion feeds back into product design, encouraging modularization of costs into separable components. Each component becomes an opportunity to shift cost outside the visible price boundary. Over time, customers adapt by expecting additional costs but still anchor on the base price due to comparison constraints. This stabilizes behavior around a known but uncorrected distortion. The system no longer operates on total value optimization. It operates on signal alignment, where success depends on controlling what is visible rather than what is incurred. The equilibrium that forms is one where perceived value is systematically inflated relative to actual cost. Visible price remains low across competitors, while hidden burdens accumulate across transactions. No single actor introduces this distortion deliberately at the system level. It emerges from repeated rational adaptation to a rule that rewards visible price advantage. The pricing system stabilizes in a state where the signal of affordability is maintained, even as the underlying cost structure becomes increasingly opaque and misaligned with perceived value. As hidden cost layers accumulate, the time horizon of decision and cost realization separates further. Customers decide at the point of visible price, while actual burden unfolds later, weakening the corrective effect of past outcomes on future choices. Because the cost is realized after commitment, switching becomes more constrained in subsequent decisions. This reduces the impact of negative experiences on initial comparison behavior, stabilizing reliance on the same distorted signal. Firms observe that delayed cost realization does not significantly reduce demand at the selection stage. They extend the delay structure, increasing the portion of cost that escapes early-stage evaluation. As this delay extends, the pricing signal becomes increasingly front-loaded with benefit and back-loaded with burden. The system shifts toward temporal fragmentation, where value perception and cost experience no longer align in time. Information asymmetry deepens as the full cost structure becomes harder to reconstruct even after multiple transactions. Customers experience outcomes but cannot easily map them back to initial price comparisons, weakening feedback accuracy. This prevents the formation of a reliable correction mechanism across repeated interactions. The system continues to privilege visible price signals, reinforcing the same selection pattern. At scale, competing firms converge on similar opacity levels to avoid disadvantage in comparison. Any reduction in hidden cost reduces competitiveness, tightening the constraint around maintaining distortion. The feedback loop strengthens as more firms align to the same structure. Visible price competition intensifies while hidden cost extraction becomes the primary margin channel. This creates a compression effect on visible pricing, where differences between options narrow artificially. Customers interpret this compression as increased market efficiency, even as underlying costs diverge further. The system now amplifies small changes in visible price while ignoring larger variations in total cost. Decision sensitivity becomes misallocated, reinforcing behavior that tracks the wrong signal. Over time, product configurations adapt to maximize separability of cost components. Each separable unit increases the flexibility to shift cost outside the visible boundary, reinforcing the same incentive. This structural adaptation feeds back into pricing, making opacity easier to maintain and harder to reverse. The system becomes more rigid, as transparency would require coordinated deviation across competitors. At this point, the distortion appears stable, but its persistence depends on continued misalignment between signal and experience. If cost realization were to become more immediate or comparable, the loop would weaken. However, the existing structure actively resists such alignment. Delayed, fragmented, and indirect costs maintain the separation, preventing convergence toward total cost evaluation. The result is a self-reinforcing equilibrium where both sides operate within the same distorted frame. Visible price remains the dominant signal, while hidden burden continues to expand without directly altering selection behavior. The system settles into a structure where visible price is the primary competitive signal. Firms that minimize this signal are consistently selected, even when total cost is higher, reinforcing behavior that prioritizes presentation over actual burden. What the system now rewards is not cost efficiency, but the ability to shift cost outside the comparison frame. What it ignores is the full economic impact experienced after commitment, leaving total cost largely disconnected from initial selection. Attempts to compete on complete price transparency are filtered out during early comparison. This constrains future behavior, pushing all participants toward maintaining hidden cost layers to remain viable within the system. Over time, both firms and customers operate under the same distorted reference point. Decisions continue to follow visible signals, even as the underlying structure ensures that those signals no longer represent the true cost of participation. The equilibrium stabilizes not because the distortion is corrected, but because every rational response reinforces it. As the incentive remains tied to what is seen, behavior continues to align with the visible price, regardless of the hidden cost it conceals.